In what way do you think they should start teaching people at the age of 15, 16 about money?
I think they should start even earlier, if I'm completely honest with you. What is good debt looks like? What does bad debt look like?
Some people who are intelligent still struggle financially. Why do you think that is?
That's a very good question. And I think the only way I can answer this is you're only going to grow, and that's through building wealth. And my plan is building wealth through actual investing in equities at the moment, as opposed to properties and real estate. Within the finance area altogether, there's a lot of scams. We've always got to be very cautious. It's a gamble, it's a bet, which is the reason why I don't really invest in cryptocurrency like Bitcoin, Solarium, Ethereum. I want to help others grow, because one of the key things for me, especially whilst I'm on this journey, is to educate others, because we're not taught that in schools. Rather than putting all my eggs in one basket, I had to explore different routes and avenues. I didn't grow up with a great financial background. My parents were both working class. We went on holidays where we stayed in 3-star hotels. So for us, we never had that financial independence that a lot of us have today. So it's made me realize and understand just how important it is to learn and educate yourself about finance. You should try and spread that risk. Don't just go all into, let's say, equities. Don't just go all into real estate, and don't just go all into commodities.
So if you had £1,000 today and you were starting fresh, what would you do right now?
With just that £1,000,
Yeah.
what I would do, I would split that, and I would invest that into the stock market, and I would be purely into the global world index fund, and the other £500 I would invest in myself.
How so? Some of your content is about some banking hacks, right? I want to get to know some banking hacks. Like, what is a banking hack that most people don't know about? Alright, guys, welcome back to another episode of Vero. Today I'm joined by Raj. Raj, nice to have you on.
Thank you for having me. It's a delight to be here.
Yeah, thank you, man. You work in finance.
I do, yes.
I've seen your social media. Just a quick background before we get into it.
Sure.
What is it that you do? Who are you, and what is your content about?
Okay, so I'm Raj. I'm a qualified accountant. I've around over 14 years experience, and I specialize in fintech, which stands for finance technology. And now I'm on a journey. I've just launched recently on TikTok and also Instagram. And my aim purpose is to be able to educate others in the space of personal finance, investing, and banking. So I think for me, I want to help others grow, because one of the key things for me, especially whilst I'm on this journey, is to educate others, because we're not taught that in schools. So I'm on a mission here.
That's good. And speaking of finance, what's the biggest financial mistake you've made?
I would say this biggest financial mistake I made was around 4 years ago. So around the pandemic, as you know, we had a stock market crash, and there were so many opportunities whenever that does happen. And I decided to invest in a company called ASOS that specializes in fast fashion. And I did really, really well there. So I invested £1,500, and I 6x my money. So I had a 600% gain on that.
100%.
600% gain, yeah.
Mm.
So I did really, really well. So in the end, I made 10,500, yeah. And with that money, I decided to reinvest in another fast fashion company that had a bit of a blip at the time. And I thought, well, I've just seen what has happened with the previous fast fashion retailer, ASOS. And I thought, well, I'm going to reinvest that money in a different company called Boohoo. And I bought the stock for around £1.80. And I noticed that the money that I put in started to reduce significantly. And it went to a stage where everything I'd invested was sitting to around £1,000. So all that money that I made from that massive gain, I started to lose it quite quickly. But that, as I say, it was kind of a journey for me, because it's taught me a lot in the investing world. And I think one of the key things that I've learned from this is that single stocks purchasing and buying is a very risky game. And rather than putting all my eggs in one basket, I had to explore different routes and avenues. But I think what I've done here is I've failed fast, but I've learned very quick. And I know I will never make that mistake again. Because I think when we look at things like investing, we can do all our due diligence. We can look at annual reports. We can look at profit and loss statements. We can look at balance sheets. We can look at what their growth looks like and what they're planning, what their ambitions are. However, there are certain things that we can't control around us, such as the cost of living crisis, where Trump decided to, bomb Iran, for example. There are certain things out of our control. We had the oil spill in the Gulf of Mexico by BP, which in turn made the share price completely fall. So there are certain things our, outside our environment, and it's an external factor that we can't control. But I think it's something that I have to learn quite quickly, and that's not to invest in single stocks anymore. So I decided that I've got to take a slightly different avenue when it comes to investing. But it's taught me a lot, and I hope as I'm investing, I'm getting more and more wiser and able to educate others based on my mistakes I've made.
Speaking of learning, first I would like to ask, what was your how was your upbringing when it came to finance, financially?
So finance at home was a bit of a taboo. We never really looked or talked about finance in such depth that we do today. We talked finance more around, where can we find a good saving for broadband, for energy, and look at little savings in that respect. We look at where we could get the best interest on our savings account. I didn't grow up with a great financial background. My parents were both working class. We went on holidays where we stayed in 3-star hotels. So for us, we never had that financial independence that a lot of us have today. So it's made me realize and understand just how important it is to learn and educate yourself about finance. So I would say I'll probably say it's giving me a lot of hunger to learn more about finance, because I want to try and give myself and my family the best upbringing I can and not go through those hardships that I've seen my parents go through.
Mm. And you said that obviously in school, I can see that you're frustrated by school not teaching us about money. What In what way do you think they should start teaching people at the age of 15, 16 about money? How do you think they should start teaching people?
I think they should start even earlier, if I'm completely honest with you. I think the generation we live in today, everything appears to be on your smartphone, and that's loaded. Apple Pay, Google Pay, it's all on your wallet, right? And I think it should start a lot earlier, because what we don't want to see is the generation that we've kind of just seen and gone through, for the Gen Z generation to continue the way the education system has been going. Because when they finish full-time education, irrespective of whether they decide to pursue college, further education, go to university, again, they still won't understand anything about managing their finances. And rather than learning about how to read and write poems, I think they should become more educated in terms of understanding what is good debt looks like. What does bad debt look like? So, for example, good debt, we could see maybe a mortgage might be considered as good debt because, again, we've got an asset against it. But bad debt would probably be things like credit cards, loans, things that essentially have loan sharks, where you have high interest rates against some of these debts that you're borrowing against, that tend to cripple a lot of families and then end up in bankruptcy. That's because we've not been taught that at school. And these are things that school should be teaching, because our life revolves around it.
Yeah, 100%. 100%. It is frustrating that they don't teach it. I mean, look, when it comes to school though, it's all like, I mean, I've noticed that sometimes people who are intelligent, this isn't to do with sports, sorry, but I've noticed in general, sometimes some people who are intelligent still struggle financially. Why do you think that is?
That's a very good question. And I think the only way I can answer this is someone can be very, very intellectual, but however, they have a different behavior around money. And their behavior around money could be that the fact that they're earning very good income as a salary, they perhaps decide to use that to buy maybe more materialistic things. And they feel as though they may have to portray that in a different light to show that, their great education or great intelligence can be supported through portraying themselves that they have a great lifestyle to support that. However, they may not have nothing to show for that when you look at their wealth, for example, or their portfolio, or they may have a very small pension pot, purely because they've probably got a very high mortgage that they're having to service. Now, where they'll feel financially strained is if ever they were to lose their jobs. and they have no savings,
backup.
no emergency pot there to actually dip into, they're really going to feel financially stretched. And I think if you was to compare somebody that's, let's say, earning 100,000, that's actually earning good money, however, is actually using all that money that they're earning on all these materialistic, expensive lifestyle, versus somebody that earns 50,000 but is investing, let's say, 10-20%, that has wealth but is also has got better financial discipline around his money. So he is paying himself first. So he's investing in the stock market every month. He's automating that, and he's doing this in a secure way where he's buying into index funds that tracks the market, and he's getting good growth from it year on year, and he's staying invested, rather than somebody that's not investing at all and again is living paycheck to paycheck. It's a means to an end to that person should they lose their job.
Mm. And with these sort of people, how often do you bump into people who are having these sort of problems?
All the time. The thing is, they expect that the more they earn, the more wealthy and rich they'll become. However, the way they're looking at it is incompletely wrong. The more they don't have a problem in terms of earning money, they have an issue in terms of how they are managing their money, because they are managing their money incorrectly. They're spending things on materialistic items, on car finances, for example, and these are depreciating assets. Materialistic items, it's only to portray an image. It's to keep up with, lifestyle trends. However, those other people that are really looking to build wealth, and wealth is built silently. That's another thing. So, for example, I met a friend down the road, and again, you will not be able to tell that he has a great property portfolio asset. And again, you will never be able to tell looking at that person. However, if you looked at somebody else that perhaps is dressed probably more elegantly than that other person, you'd have a completely different image in terms of their financial status. So again, somebody that's earning a lot more money perhaps feels like they've got to keep it with a sort of financial status that everyone expects to see. And again, that he's trying to portray himself as.
Yeah. And you said obviously school didn't teach you about money. Your family didn't really speak much about money. So was there like a moment where you felt like no one's going to teach me, no one is teaching me, and you had to kind of save yourself?
I did. And the thing is, I knew that I only have so many number of hours in a day to be able to earn, and that's limited. That's limited to you and I. We all have the same 24 hours, and there's only so many, let's say, hours we can work within that day. And so the idea was that it's not about working harder, it's about working smarter. And the great thing about where I thought to myself, I've got to start learning quite quickly, and what was the turning point was actually turning into a habit and a passion, which is understanding and studying Warren Buffett and what he's doing. Him and Charlie Munger are the most successful investors around in our generation, and they've built a massive company, Berkshire Hathaway, around investing, and they've been so successful. And that, for me, investing, whether it's in whatever asset class that is, it could be in property, it could be in cryptocurrency, for example, it could be in equities, it could be in commodities. That's what's going to help you build wealth. That was a turning point for me, where I knew that just from my own day-to-day income, my salary, I was not going to get rich. I knew that something else had to be done, because that's how others are delivering and executing this, and they're doing it quite successfully. So what could I learn from them? And then that's when I also started to read a bit more and go into depth about, you may have heard the book Rich Dad Poor Dad, Robert Kiyosaki. And again, it goes back to that classic example. You asked me the question about why are you frustrated about kind of the education system, and it's similar to what Rich Dad Poor Dad talks about. Robert Kiyosaki just wants to learn more about money. So the rich dad would teach him about how to make money and how you need to focus on the asset column, because assets is what's going to bring income into your pocket, and that's through these assets.
Yeah.
Whereas the poor dad just decided just to have a normal salary but be very well educated. However, a lot of the things that he had was a house only, and again there was a mortgage that wasn't an asset, it's a liability, because it's taking money out your pocket. So simple things like that, and bringing a little bit of context and understanding to that, it's really helped to shift the way I think and understand and learn about money.
Yeah. Some people, they do, like, it's so traditional about the educational route, right?
Yeah.
And I don't think it works the way it used to work
No,
now.
no.
I think now it's all about skill and experience.
It is.
So do you think a lot? I mean, obviously there's some I would say jobs or careers that require you to go university, like for example law or something like that. If it's not something like that, what do you think? Do you think going uni and getting a degree is actually worth it?
I think when you look at the cost and you look at the debt that you come out with, and then there are other alternatives nowadays. There are apprenticeships. I appreciate if, for example, you're trained to be a medical doctor. I mean, I don't think it's negotiable. You have to go through university, you have to get a medicine degree, and then following on from that, you've got to do further exams. And you have to constantly keep learning about the new interventions and literature within that space. However, when you look at the cost of debt, and again, the university tuition fees keep rising, I think there are alternatives out there. People are starting to explore a lot more, and I appreciate that it doesn't quite give them the experience that university does. However, at the end of it, you've completed an apprenticeship. You've got those years of experience doing the hands-on job, because a lot of those people that come out of university are still struggling to find jobs, and that's the thing. And they could have a degree in let's say in law. However, do they know how to manage their finances? Probably not. You know, they may within the next couple of years, for example, make the wrong decision, and for example, get themselves into crippling debt purely because they decided to take out a credit card and buy things and not pay it off every month because they thought, I don't really need to, but they don't understand the impact that this is going to have on their credit score, for example, which will impact them later years along the line when it comes to buying a house and they need a mortgage, for example. So I think looking back at university and the fees, I mean, I have a friend that I was speaking to just the other day. He got paid an £18,000 bonus. And he said, Raj, you won't believe it or not, I've got taxed and also NI £4,000. However, I've also got another £4,000 that's been deducted from me on my student loan repayment. So what am I left with after paying all that in taxes and loan repayments? He said, I'm pretty much left with around 40% of my bonus. And you think, crikey, that is a lot of money. And I think nowadays I look at the younger generation, it's getting harder because house prices have increased. You look at student loan debt, everyone's pretty much coming out with student loan debt minimum around 50 to 60,000 pounds. And even though that's going to be wiped out after 40 years, that's a long time. But also the interest that you pay on that student loan is pretty significant.
And so I want to get back onto that point, but what I want to get into now is a bit about what made you start taking trading bit serious, stocks serious. What was the moment where you said, okay, now I'm gonna take this serious?
So for me, investing, I don't really trade. So trade is more kind of around where I'm really looking to turn around whatever I've traded on in a short space of time.
Okay,
Short-term
yes.
trading.
Yeah.
I'm more of a long-term investor. So what I mean by that is I invest maybe 5, 10, 15, 20, 30 years for the long term because I see better growth in that and keeping my money invested in those assets. What the reason why I really took this seriously, I think pretty stems back from the cost of living crisis. Typically, I would put money into a cash ISA, but at the time when we were going through the cost of living crisis in 2022, when Russia decided to invade Ukraine, inflation was at its all-time high of around 7 to 8%. The Bank of England put the interest rate up to about 5.25%. Even if I put my money into a cash ISA, I was only really getting around 5%, if that. And I still thought there's a massive gap there because this cost of living crisis is having an impact on our energy bills, fuel prices, our supply chain, our distribution, because it's costing more to be able to put stock on shelves. So for me, I thought, right, what is the best way to invest my money so that I can beat inflation? And the thing I turned to was actually investing my money into ETFs. So ETFs, it stands for exchange traded funds. And the one investment that I always make every single month is in global index funds. So what that does, it takes all the companies in all the stock markets and it invests. So assume, or just think of it as if it's all these different companies in a basket, and you're investing. Not only are you investing just Tesla, you're investing in Tesla, Amazon, and all of the companies in around the world. So Samsung as well, Sony, across all these different markets. And again, I'm not just concentrated on the US. And what history has told us, and the stock market performance on global index funds, is that it's got an average return around 8 to 10%. So where inflation stands around 7 to 8%, and as time evolves, again, it's coming down slowly, I'm still getting better growth in investing as opposed to having my money tied up in a cash ISA, because I'm not really seeing the growth that I want to either. And I think and also investing in a global index fund, I've got great diversification. So I'm not just concentrated on just the US market. In case anything happens within the US, then I know that my portfolio is going to take a hit. I look at global diversification. So we've got a bit of Korea in there, Japan, Germany, France, UK, US, etc. So I've got a broad diversification across the globe.
Mm. And was you scared of losing money when you started?
Absolutely. I mean, the most important thing I say to anybody, if you're going to start investing, be prepared to lose what you're investing, because that's what investing could potentially do. Only be prepared to invest what you can plan to lose or risk, right? And I think we can all do our due diligence. However, there is always an element of risk there. But I'm a firm believer in, don't put all your eggs in one basket. Look for diversification where you can. Even if you said, look, I really like the US, I would say S&P 500 is great. So that's where it attracts the top 500 companies in the US, and you're investing, rather than just investing that just one company, investing all the top 500 companies in the US. Again, that gives you a great balanced risk appetite. And I think that is where you're going to get the best growth, I think, more than anything at the moment.
Was there like a moment where you kind of went from I need to work more or earn more to I need to make my money work for me?
Absolutely. So I think as I've made those investing mistakes, as I have, as I told you with that Boohoo investment, I realized that I can only work so many number of hours. But also, we've got to appreciate that tax in the UK isn't that friendly, right?
Yeah.
You know, the tax man always takes a decent cut from what we earn. So if I invest my money and I invest it through a stocks and shares ISA, anything that I earn, whether it's capital gains or it's also dividends, so if I sell and whatever I make on that, it's in a tax wrapper, I keep everything that I have. And that's where, for me, there is a ceiling to what I can earn. So I can earn, let's say, for example, £60,000 doing my 9 to 5. And then on top of that, let's say I have another job, and that could be, let's say, doing Uber taxis. I know that there is a cap there on what I can potentially earn based on the number of hours. However, when you look at investing, there is no ceiling there.
Yeah.
And that's the beauty of investing, because my portfolio can keep growing and growing and growing, and there is no ceiling there. Whereas I know with my salary, there is a cap there, and my employer is going to say, no, I can't give you what you're demanding, purely because that's the ceiling there. And that's the beauty of investing. There is no ceiling. And the more money you pump into it, you start to get more and more confident and understand how the stock market's moving based on certain external factors, for example.
Yeah, like war and stuff. Yeah.
Exactly.
Yeah. When you first started, what books were you reading books at that time? Both related books, or watching YouTube videos, or learning off the internet, learning anywhere basically?
So I learned a little bit through watching YouTube videos. I learned a lot from Warren Buffett about how you should actually analyze their cash flow statement. You should look at the balance sheet. You should look at the profit and loss. So these certain things will tell you, look, this company is heavily geared. So what I mean by that is they've got a very high proportion of money that's borrowed money. So therefore, if the banks decide to recall back their debts and this company doesn't have a good cash reserve, unfortunately, it could go into administration. If they don't have a healthy profit margin either, you know, they may not be paying dividends, for example, back to its shareholders. So I look at all those factors. I look at, you know, whether the company has good growth ambitions. If we look in the space of retail, are they looking to open a number of retail stores, or they're looking to make investments in them retail platforms to attract growth in new markets. So there's all different things when looking at a single company, but I've moved away from that, and I want to try and automate and streamline that now. And where previously I was spending a lot of time and doing all the research I could in one specific company, and again, as I say, based on external factors that again is out of the company's control, things may not go according to plan, and it takes a hit on your portfolio value, right? So I just moved more into ETFs, which I think gives me that great diversification, but also I think it's got more controlled risk around it.
So do you only do like long-term investing, or do you do short-term investing as well?
Predominantly where I'm at, I do only long-term investing, purely because I'm happy to wait at least 15, 20, 30 years. And the great thing about long-term investing is something called compound interest and compound growth. Albert Einstein said that this is one of the 8 wonders of the world. So what I mean by that is, for example, let's say you invested, let's say today, and in the next 2, 3 years, you made a gain. And then on that gain, it's been reinvested into the stock market. And then the gain that you made has made, again, another return. And that happens over and over and over. And that's the beauty of compound interest, because when you come to retirement, when you initially, let's say, just had an investment of, let's say, overall within 30 years, let's say 200,000, because of compound growth and compound interest, you probably would have made 350, 400,000. So you may have doubled what you've actually put in. And that's the beauty of compound interest and compound growth.
But what stops you from doing shorts as well?
Shorts is very, very risky. I know a lot of people that do short-term trading, and that comes from the space of where they look at foreign exchange trading, Forex. And there's more chance of you losing than there is of winning, but you're putting on a lot of short-term trades or bets. And again, the market could swing either way, and you could certainly apply stop losses, and also you could also apply take profits on those. And I have done that myself. However, there's a lot that goes into doing short-term trading, whether that's in, again, foreign exchange markets and foreign currency transactions, or whether you look at something called CFDs, where you're betting against a company will either perform well, or again, it would have a sip on a specific day. But again, you can lose your money quite quickly, but at the same time, you can make your money quite quickly. But as I say, the probability of you making money, a lot of money in a short space of time, it is there. However, it's a lot slimmer compared to losing it. So it's something that I try and stay away from, and that's trading.
And if I logged into your investing accounts right now, what would I see?
So if you were to log into just my equities account, I think you would see investments in 3 main places, and that's mainly in ETFs. So I always try to do investments through ETFs. So you'd find a hell of a lot of money invested in the global index, which again tracks all the stock markets across the world. I also have invested in the S&P 500 tech companies only, because I've seen significant growth in that. So that is your Metas, Amazon, Tesla, Nvidia, etc. I've also invested in commodities, so precious metals, so silver, gold, and I'd also say the last one here is actually in quantum computing, because that's what they say is going to be the next AI.
Okay.
So I would say within those main 4 ETFs, that's where I tend to allocate my investments.
And what percentage of your investment is in ETFs?
I would say pretty much 100% is split across all those ETFs. But if we're going to take a broader outlook and look at all my investments, it sits, I would say, around 60% actually in equities, so in stocks and shares. I'd say around 20%. So no, I would say around 30% sits in real estate and property. And I would say the other 10% sits in physical commodities and currency.
So the last question was, what percentage is in ETFs, right?
Yeah.
Okay. And what percentage do you have in individual stocks?
I don't hold any individual stocks after my really, really bad performing stock. So I tend to move away from individual stocks. And my recommendation for somebody who's starting off as a beginner is to perhaps not put all your eggs in one basket and probably look for diversification where they probably want to look for higher risk, higher return. Single stocks will give you that. But it's quite difficult to try and beat the market, even though there are a lot of stocks out there that people talk about, especially online. And I see it all the time when I look at social media. There's a lot of companies out there that influencers will talk about where they say, look, I'm going to invest heavily. I'm going to invest heavily in SpaceX, for example. And over the last 3 days, even though it's actually took off, the last 3 days has shown significant losses. So again, it goes to show how, again, single stocks is very risky. So I tend not to invest at all in single stocks. And my recommendation is not to go for those hype stocks where people are pumping and dumping those stocks essentially, because again, the risk is pretty high there. And one day you think I've made fantastic returns, and then you could look at your position, either the following day or by the end of the week, and you lost a lot of those gains. So you just got to understand what is your long-term position, because you got to remember the stock market can be very volatile and it can't react to specific things. So for example, we've just had Keir Starmer resign today. So, the stock market has dropped a little bit because of that.
Yeah. So how does the market react to that? So you said it dropped.
Yeah, the market did drop because again, it shows a little bit of instability within the parliament. And again, we don't really have anybody at the moment besides, Andy Burnham to take over. So it's about what investors think our new prime minister will actually do for the country and whether they'll be able to sort out our public finances.
A bit of a political question.
Yeah.
Do you think Andy Burnham is the right man for the job?
I'll be honest, I don't know too much about Andy Burnham, in all honesty. But I just hope that he can recover a lot of those things that Keir Starmer has put in place and actually sort out immigration and also the energy crisis that we're currently experiencing today. So I think President Trump has called that out, and he said, look, these are things why, people haven't favored Keir Starmer in the first place, purely because of some of the wrong decisions he has made.
So do you have any cash reserves as well?
I do. I have cash reserves, and I think this is so important. And these cash reserves, I see it more as an emergency fund. And I think for anyone out there, they should have at least around 3 to 6 months of their baseline costs. So what I mean by that is you should take your living costs, and let's say, for example, that covers your mortgage, your rent, your utilities, again, your transportation. You then multiply that by either 3 or 6. I multiply that by 6 because I like to be on the side of more cautiousness as opposed to only doing 3 months, because if ever I was to be laid off from work, I can always dip into that pot and cover myself for 6 months and not have to worry so much about finding a job so quickly. And the other thing I would also say here, Aman, is when I do keep the cash in a cash reserve, I put it in a high yield savings account. So there are bank accounts at the moment, such as Revolut. There's also First Direct that are also paying up to 5 to 7% interest on those high yield savings. Now, don't get me wrong, you do have to pay a small amount of tax. However, at least you're still getting some interest on that money to cover you for rainy days. Could even be that your boiler breaks down, you could have a roof leak, it could be anything, we just don't know, but at least we can prepare for those rainy days because we can dip into a cash reserve there.
And what's the biggest misconception people have about investing in ETFs?
People's misconception is that they don't get massive growth, and again, they've got to weigh it up. They've got to weigh it all together, because if you look over the past 20, 30 years, the S&P 500 has averaged 8 to 10%. Some banks are only paying 2-3% interest, right, on a small pot of money, or that sits in a cash ISA. And what you can remember, if you look at how the stock markets have performed versus savings, investing has absolutely skyrocketed and outperformed savings all day long. And although that they've got slower growth compared to investing in a single stock. It's giving you diversification, but it's also giving you reasonable growth. 8 to 10%, I think, is pretty good. And over the last 2 3 years, you should when you look at the S&P 500, some years it's giving you around double digit growth, 16, 18, 20%. So that's quite good, and that sits in an ETF.
Have you seen people, because obviously with ETFs, like you said, it's more for long-term gain, right? Have you seen people lose patience and make a silly mistake?
In ETFs,
Yeah.
I have, because I've seen others that have invested in ETFs that are exposed to high risk. I know a few people have invested into an ETF, but that's in a precious metal, and the precious metal prices have fell significantly recently, purely because a lot of these precious metals are priced in US dollar. The US dollar has strengthened, making it very expensive for international investors to buy. And also, because of the tech rallies that we've had recently, they're not looking to invest their money in precious metals and in safe havens like gold, like silver, and any other precious metals that we have today. And instead, they want to pump their money into these tech rallies that we've had in the stock market and into equities.
Is gold value going down right now?
I've seen that again. It has came down slightly. I think over the last, say, 3 months, it's probably down maybe about 10-12%. But I think with a lot of these things, if you look at the last, let's say, 20 years, again, it's probably doubled its price or even more. So from a long-term perspective, it's definitely something that, again, you should have a mixture or a good combination within your portfolio of assets. You should try and spread that risk. Don't just go all into, let's say, equities. Don't just go all into real estate, and don't just go all into commodities. Try and have a balanced portfolio, because we don't know, you look at real estate, for example, and you look at property, you look at the Renters Reform Act. If someone pumped all their money, let's say, in just real estate and in the buy-to-let market, and then all of a sudden, there isn't favorable landlord legislation, they've again, we've got falling house prices. They are unfortunately tied, in just that asset class. But wider and broader diversification gives you that option to at least see a more steady growth along that portfolio.
So if you had £1,000 today and you were starting fresh, what would you start? What would you do right now?
With just that £1,000,
Yeah.
what I would do, I would split that, and I would invest that into the stock market, and that would be purely into the global world index fund, and the other £500 I would invest in myself.
How so?
So I think I would look into investing into a course where I think there's going to be growth, and I think at the moment there's a lot of growth, especially within the tech sector and in AI, and it seems to be growing. I think a lot of us today have either Claude, ChatGPT, or Gemini, or even Copilot downloaded on our phone, because we're so heavily dependent and relying on them. But it's a skill, and it's a skill that's always going to be there, and it's a piece of technology and a capability that's never going to go away. So I think we need to embrace it, we need to learn about it, and we need to go where the growth is. So I think investing in yourself is probably one of the best investments that you can actually make today, but also investing in the stock market to give you that long-term growth as well, and stay invested.
Yeah. And speaking of AI, how do you or do you even use AI to help you with your finance and with certain decisions you're going to make?
Financial all the time. Sometimes I, probably similar to you, we all get a little bit lazy, where we don't have the time to go through all these stock market news around that particular stock or what's going on in the news. So what we do is we put a prompt into AI, and we try and get that information in a format where we can easily digest it. And so I'm heavily dependent on AI to give me that information, as opposed to me go around and researching all these different articles to try and give me that information. So I think AI is only going to increase its over time, and we're going to become more and more dependent and lean into it a lot more. So why not and learn that skill?
How often do you invest?
Every month. And I don't just invest just sort of within our stocks and shares ISA. So I invest and I try and automate this, because if I was to talk you through what I invest, so every month I invest through my company's pension. So that goes into a fund. So that's invested. So that's automated. I invest into a stocks and shares ISA. I also invest into a SIP, which stands for self-invested personal pension. And I also invest into a junior ISA, where you get a tax-free allowance of £9,000 per child to invest into the stock markets. And as you can appreciate, to do that for 4 different accounts, that would take me a long time. So where I can automate that, but also take away that human emotion by extracting those funds manually each time, there's a bit of emotion with that. But I pay myself first and I invest that. And then all the other funds come out in terms of the direct debits for a mortgage and utility bills and all the other bills that I've committed to.
And do you invest regardless of market conditions as well?
Absolutely. And I think the most important thing is to stay invested. The market's always going to go through turbulent times, and we've seen that. We look at the dot-com bubble. We look at the financial crash that happened in 2008. We look at the cost of living crisis. We look at that war in Iran, and what you'll notice is that the market would always recover. And when either a global pandemic or whether a war happens, I think it's a perfect opportunity to invest, because I can pick up stocks and shares in ETFs at a discounted rate. So I see it more as an opportunity. But what you remember is that not even Warren Buffett or even analysts can predict when is the best time to buy, because again, market conditions are constantly changing. But if you stay invested over the long term, what I've seen, what I've experienced in my time in investing, as long as I'm staying invested, I'm going to get my growth. I'm going to make those returns that I want to see every year. And over time, my portfolio is going to look quite healthy compared to somebody who's always trying to find the right time to buy. Because if you're trying to buy Nvidia and you're trying to buy Nvidia, let's say $200, and one day it's up by 202 and then 207 and 210, you missed your opportunity. So by trying to time the market, that's not going to work. It's about the time it's spending inside the stock market. That's what's going to get your real growth.
And when would you ever say that there is a time when it's too late to invest?
I would never say there's a time too late to invest. The only time when I would say it's probably applicable is somebody that actually needs those funds for a large purchase, and they don't have that level of risk that they once had, purely because they want to move away from any risk involved when looking at the stock market, purely because they just want to put this money down, let's say, to pay off their mortgage. And again, they don't need that money in the near future for the growth, because they're able to retire with that money and that reserve that they've got there.
And touching upon the Iran war and stuff, obviously right now they're struggling to make a deal right now, right? We heard there was a deal, heard it's closed, and since then I've just been hearing both of them in the same page. I'm seeing both of them.
Yeah.
Right. What do you think this is doing to the market right now, where every day it's on, every day it's off?
It's bringing uncertainty. Every single day we're hearing different news in the media and what Trump's posting on his X account. And again, the market's reacting. And I think the market, I thought, was corrected once he announced that there has been a peace deal in place. However, I think by just staying invested, that's probably the best thing you can do, because we don't know whether or not, this peace deal, it has been signed and delivered, because I just heard yesterday that the Strait of Hormuz has been closed
again.
Yeah. So again, all these things, all these variables, it's just constantly causing turbulent times in the stock market. But the other thing I'd also say is, when it comes to investing, and we do have, whether it's another global pandemic, or we have another war outbreak, or we have a cost of living crisis, whatever happens, right? Don't panic sell. Because a lot of my friends, what they've done is they've actually panic sold, and all of a sudden they've made some losses, and then they wish they just sat tight, just sat on that turbulent ride and just let the ride just play out, and that's where they would have seen the gains back up in their accounts. So rather than seeing reds, they would have seen greens. So it's just being able to ride out those turbulent times, and that's by staying invested. So don't panic sell, sit tight, and just continue to invest just as you typically would.
Yeah, I mean, yeah, panic selling is not the right decision, obviously. But is there no time where you say, okay, no, now I do need to actually sell?
I think you could probably say the good time to sell would be, let's say you have a target in mind. Let's say you want to sell because you want to be able to pay off your mortgage, or you want to be able to give a loan to, let's say, a family member. So therefore, you would sell, or you'll probably come into retirement age. So therefore, you think to yourself, I just want to take that 25% tax-free lump sum, which you can take at the age of 57 at the moment, which will be rising to 58. And again, you are looking to sell your position in this particular fund that you've got it invested in. That would probably be a good time to sell. Or you just think, I have actually made that gain that I was expecting. I'm happy with that. I'm therefore going to invest in something else, or I'm just going to use that money for financial freedom purely because you're looking to retire, or you're looking to go on holiday, or you just want to be able to use that in a different personal life circumstance.
But is there ever like a situation where you're looking at the market and you're looking at the future? But is there ever a time when you're, instead of saying that, no, I'm going to ride this rocky wave, you say, no, I'm gonna take my money out? How do you kind of get to that point, if you know what I mean?
Yeah. So when do you think is a good time to take profit and to say, right, okay, I actually want to sell this position?
Yeah.
So I think circumstances like this, if you feel as though you are hearing some news, or you become a bit speculative about this particular company or about what's happening in that specific country, and you think, I've got a lot of nervousness around this, there's a lot of uncertainty, and actually want to just sell purely because you've either got aspiration to sell because you want to do something, or you just don't feel very confident in the concentration that you've got in a particular market, then I think that is a good time to sell, purely because it's giving you that confidence that you're happy with your buying position, you're happy with that selling position, you're happy with that gain, you're happy with how that investment performance has been over the last year or two, or depending how long you invest in that, and you're happy to invest that money elsewhere or to fund something else, then I think it's a good opportunity to sell it because you're happy with the gains you made.
So I want to know, what's your process like of trading, of investing? Sorry, what does the process look like for Rod?
So for me, what I do is I set up a pretty much a standing order or a direct debit. So I've got a direct debit, a standing order that comes out of my out of my bank account, and that goes into Trading 212 every single month, similar to my company pension, similar to my SIP, and also similar to my junior ISA. That gets funded straight away into those respective platforms, and I've automated that it invests whatever I've contributed to that investing platform into a specific ETF and fund, and that will automatically buy shares in that respective ETF every single month without fail. That's the process I go through, and that's by automating it, because it takes away that emotion and also that process. And you can appreciate, I've talked about 4 different investments that I make every month. So there could be one that I could potentially forget. So that's what I do, and I think that's what helps build financial discipline and great financial management. And as I say, you're only going to grow, and that's through building wealth. And my plan is building wealth through actual investing in equities at the moment, as opposed to properties and real estate, purely because I think I'm getting better returns in equities the way the market has been going, especially with these tech rallies in the Magnificent Seven companies at the moment.
So have you invested in properties as well?
I've invested in properties as well. Let me tell you about one property investment that I made, my very first one. So I was 24, and I was really, really scared, purely because I was living in Reading at the time, so not too far from where we are at the moment. And my parents said, look, go and buy a house. You're at the moment renting, you have been renting for 2 years, and renting is dead money. And we had that great track record of house prices increasing year on year on year, which we haven't had over the past so many years, purely because of what they've introduced in the housing market about stamp duty and everything else. Um, and so I was 24. I went to go see a property by myself. Remember, I've got no experience in buying a house. And again, you're not just talking pocket change, you're talking, hundreds of thousands of pounds. And I went to go see at least, I think, about 6, 7 properties. And for me, I was becoming more and more knowledgeable the more properties I was seeing in terms of space, but also I was looking at a perspective of an investment vehicle, because the plan was for me to rent rent 2 rooms out, and also for me to live free. So the money that I would make from renting the 2 rooms, because I also used to travel 3 times in a month for 3 weeks, and I'll stay at home for 1 week, so I didn't need the biggest room. So for me, it was more about, right, how can I get these other 2 rooms rented, where I have an all-inclusive deal where I'm renting out per room, but all bills inclusive, but I can live for free. So it covers my mortgage and my bills. So there were 2 double rooms that I'll rent. And at the time, the rate was, I think, around £600 per room for both double rooms. And I just had a single room to myself. And I bought that property for £190,000. And when I look at the value of that property, you're looking around £425,000 that is valued for. And that's what it's given me in the space of 14 years. So that was back in 2012 when we had the London Olympics in London.
Was that when this country was kind of recovering from recession
Yeah,
as well?
exactly.
Oh,
So it was a
okay.
perfect opportunity to
Yeah.
buy as well. And I only really noticed the growth after 2 years, because I had a fixed rate mortgage for 2 years that was coming up for renewal. So then I had a mortgage valuation done on the property. And the person who valued the company said, look, it's actually valued for £325,000. So remember, I picked up this property for 190. After 2 years, it's been valued for £325,000. And I've also got my tenants asking me that if I've got another property available where they want to rent. So I thought, wow, this seems like it's doing pretty well in the housing market, right? Because there's all this demand. I'm getting this great growth. I'm living for free. It seems like, a great thing to do, and that is investing. And all along, my parents kept pushing me and pushing me. But again, I was scared because I had to rely on the bank of mum and dad for a deposit, but also I was putting £10,000 of my own hard-earned cash into this property that I think, will I not get tenants to move in here? Will they like it? Will they not? Is it a great area? Is it not? And we've all got doubts in our head whenever we're making a big purchase like that. It's the biggest purchase we'll ever make, and that is, again, in property in that regard, especially when you're at the age of 24, right? And so yeah, I was really scared, but I think more than anything, you've got to have that leap of faith. Everything has risk attached, and I think the more due diligence you do around it, the more time you take, the more bad properties you see, the more wise you become, and then you start looking at everything in perspective and think, why, I'm now ready to make that financial decision. And I think that's made me a lot more wiser when looking at property in the near future.
Yeah. And I mean, it seems like, well, there's a lot of talks about the property market crashing soon as well. So does that mean maybe in the near future it might be a good time to invest into properties again, though?
That's a really good question. I mean, for those landlords who are looking to invest money in properties, for me, I have shifted a lot of my investments out of property. But for those where we see house prices falling, what we've got to remember also is that properties can recover, but also the rights that a landlord once had, for example, you could issue a Section 21, you can no longer do, purely because the Rent Reforms Act has now taken over. So you can't just hand in a Section 21 without any reason and tell a tenant you're evicted. You've got to have good grounds to evict that tenant. So for me, even though the housing sector, it may see a decline in house prices, for me, I don't think that I have that level of control that I once had. And also, when we look at what's happened in property over the last, say, 10 years before you're able to offset interest against your tax bill. That's gone away, unless you buy it through a limited company. You also have, the extra surcharge you have to pay on stamp duty. Again, that seems like that's again risen as well. And then you also have the running cost, the repairs and maintenance, agent fees, and when you look at your profit margins, at the end of it, what are you left with? So again, it's something where people think it's passive income, but there is a lot of time that you've got to put into, again, this asset that you've got to look after and maintain and keep it up to spec, freshly painted, renovated, purely because someone wants to move into that. Exactly.
Yeah.
So I think it's not as easy as it once was. But for me, I've shifted my focus away from rental income and moved more into investing into equities and stock purely for those reasons.
So what's the biggest investment you've made?
I would say it's definitely been into property, and I invested in a few properties, and it's invested into properties within the UK and the country. So it's not just isolated to London and in Reading. It's all over Manchester, Coventry, Leicester, Midlands, Birmingham as well. Purely because there were talks about the HS2, but also we've had great growth in Manchester. So up north has been a great opportunity to invest in as well. So for me, the biggest investment I've actually made was that house that I bought in Reading back in 2012. And again, as I say, I've made a massive gain on that. And when you're looking to invest in property, you're not just putting down, as I say, just £5,000. You're looking to put down a sizable amount of up to 50,000-60,000 pounds, just so that you could get a good, interest rate on that mortgage. So it's definitely been the biggest. It's definitely been the biggest investment I've made in terms of value, but in terms of the biggest return I've made, I'd say it's definitely been in the ASOS shares that I bought and sold during the pandemic.
And have you ever lost a significant amount of money as well?
In property?
In any investment?
I would say altogether, it's probably been the Boohoo shares.
Oh.
But also, I have, we're always exploring other ways we can make income. And I did explore a few years ago Forex trading and investing. But as I say, I was copying someone's trades. And I think within the finance area altogether, there's a lot of scams that go on. And I think early investors, and especially these get rich quick scams that I see online, we've always got to be very cautious about these schemes that exist. And they ask you to join a Telegram group and to copy trades. And they only show you, their success.
The failure.
They'd never show you the failure, right? Because again, even when you look at Forex investing, you'll see lots of accounts that have been set up, and they'll show you the Lamborghini, the Porsche, the flying business class, are sitting in the most flashiest hotels, and altogether, all they're really doing is selling you a course and charging, let's say, £3,000, £5,000, but that's funding their image, portraying that on social media, just so that you buy their course. But then it's down to you to make the right trades, but they're only going to kind of tell you what they know, but then at the end of the day, it's up to you to make the right trades. So yeah, I think for me, I have lost, I wouldn't say a lot of money, but around £1,500 just through trading. But that in itself, I fell fast but learned quick that it's not something I want to explore, purely because it's a gamble, it's a bet, which is the reason why I don't really invest in cryptocurrency like Bitcoin, Solarium, Ethereum. I know that at one point, the gains were ridiculous. I know a lot of people that made a lot of money, and then they decided to sit on that position, right? And then all of a sudden they've lost a lot of money because then they never sold, right? Yeah. And again, for me, it's not regulated. It's not regulated by the FCA. So for me, I don't really know what I'm investing in. If something's tangible, i.e. I can touch it, like property, it's great. And like, commodities like precious metals like gold, silver, I know what I'm investing in. That's why I like stocks and shares, because I know what I'm investing in. There's a company there, it's being backed, it's regulated. But other more riskier, non-tangible assets like crypto, I'm a little bit more cautious around those, even though I know that there has been great gains on that over the past few years.
So when it comes to like a lot of scams and stuff, what would you say? Well, in general, what would you say separates a good investor to someone who's not as good as investing? what do you think separates successful to unsuccessful?
Okay. So I would say a great investor is somebody that keeps on investing in the market irrespective of what the markets look like. So for example, the markets could have, been through a turbulent time, and that great successful investor just kept on investing, and he's seen his portfolio, he's seen his growth, and again, he's just doing the same thing every single month. May call it cliche, it's boring, but again, it's making them rich, right? However, the unsuccessful investor, they've invested, they've seen a turbulent time, and they decide to sell. And all those gains that they could have made if they just waited and stayed patient. Remember, investing is a long-term game, and it's about staying patient. Again, it's about how long you can give your money in the market. Now, a classic example I can give you here is, if I was to take somebody who's 21 who invested £20 every single month until they turned, say, the age of 60, but only invested £200 in an ETF, right? Compared to somebody who's, let's say, 40 years old, but doubles the amount, let's say £400, up to the age of 60, who would you, again, in the same ETF, who would you say has more by the end of when they turn 60? Who would you say has more, the 21-year-old or the 40-year-old?
I'd say the 40-year-old.
You'd think that, right? But it's not. It's a 21-year-old, even though he's investing less. And that's the beauty of compound interest, because what that 21-year-old's done, he's started investing at an early age, and he's allowed his money to compound in the stock market. And again, it's what's making gains and giving him growth on the gains. And he's getting that return on investment every single year, and he stayed invested. But the person who's 40 years old, he's only been investing for 20 years until he's the age of 60, whereas a person that's 21 has been investing for 39 years.
Yeah.
So, the person who's been investing at a younger age, he's allowed more time for his money to grow in the stock markets. So that's what makes a successful investor. And that's because, again, he started at a young age and he stayed consistent. He's not sold, compared to someone who started slightly later, but also panic selling as well.
Yeah. Plus, I mean, if you're investing from young, and if you're investing monthly, you don't have to put so much in at one time.
No, you don't. No. Yeah. You can control how you're investing. A lot of people think, I've got to commit to this and I've got to commit to this every month. Remember, you can tweak it. There may be some months where you think, oh, I'm gonna go on holiday, so I can't afford to invest. But what I will say to myself is, 2-3 months after, once I've paid off my holiday, or I've recovered from that holiday expense, I'm gonna start investing again. But the thing is, you've got to stay consistent, just with everything. As long as we stay consistent with this, we can at least, see potential growth and gains, purely because it's like, with anything, when we start learning to drive, we're not good at this, but the more times you do this, the better you become, but also you'll see great growth at the end. You see that you're developing, but you're learning more along the way. And it's a journey, and everyone's at a different place on their journey, but it's about being able to understand and learn whilst you're on that journey. And we're all on a mission, to build wealth. But again, it stems back to the point we made earlier about, we're not taught this at school. We're not given a financial education. People want to sell us courses, and again, as we talked about, there's a lot of scams there. People want to sell just PDF online documents, right? But tell me, realistically, we look at that once, maybe twice, and then after we think, why did I spend £300 on that document? There's a lot of content out there online that you can learn, and it's for free. And that's what I really want to try and do. I want to try and be in a position where I can try and impart my knowledge to others in a way that's more digestible and more applicable for them. So yeah, I'm on a mission myself. Yeah.
You know what? I've actually seen that you come up with some of your content is about some banking hacks, right?
Yeah.
So I want to get to know some banking hacks. Like, what is a banking hack that most people don't know about?
I would say, when you are with a specific bank, so for example, let's say you're with Lloyds Bank and you've been with them for let's say 4 years, right? They don't value you as much as a customer. They value new customers. So that's why they are just handing out these switching incentive offers, where they're happy to give you £175, £200, and that's from various different banks. And at the moment, there's a great banking switching offer by HSBC, who are willing to offer new customers £220. But what are they giving for existing customers? Absolutely nothing. So you're more incentivized to switch. So a lot of people are actually making just good side income and hustles just from doing these banking switching offers. And I think it's great for somebody that wants to earn a little bit of passive income, but again, doesn't want to do much heavy lifting. It's a great way and it's a great opportunity to be able to, make an extra 200, £300, per month, depending on how many banking switching offers that they're able to complete in that particular month.
Is there anything that can come with keep on switching banks as well?
So that's a great question, because in the short term, if you continuously switch, it does have an impact on your credit score. And a credit score is really important and it's something that you must protect. So for example, I wouldn't recommend somebody that's looking to buy a house in, let's say, the next 3-6 months time, that they continue bank switching, purely because, again, it leaves a search on that person's credit history and credit score. So it will reduce that. So people have to be very cautious and aware of what they're planning to do in the next 3 to 6 months when it comes to bank switching, and also being able to protect and look after their credit score.
Where are banks making the most money from their consumers?
So banks have different income streams. And I think if you were to look at all their different income streams, we can break that down. We can break that down into short-term debts and also long-term debts. When I look at long-term debts, I look at mortgages. So you're looking to borrow a large sum of money over a long period of time, but at a smaller interest rate. And when you look at, let's say, somebody that's buying a house for the first time with, let's say, a capital repayment of around £1,000, around £700 of that interest goes directly to the bank. So that's their long-term debt and income strategy in that regard. And it's also short-term as well. So for example, they will also have a lending facility for short-term loans. So for example, actual loans for, let's say, £10,000-15,000, because that person wants to perhaps do an extension. So they want a loan for that. And they'll get, again, there'll be sort of high interest, maybe around 6 to 10%, just to borrow that money for, a short period of time, let's say 12, 24 months. And then finally, we have credit cards, and credit cards have staggering APRs, so annual percentage rates on what they charge on credit cards. And people need to be aware that credit cards can cripple them if they're not used in their own advantage, right? So credit card should always be paid off in full, and that's the full balance. Otherwise, you get subject to interest payments, which can be, as I say, 24.9% or all the way up to like 40-50%. And when you look at somebody that's only making, the standard monthly payments, again, you're just chipping away a little bit of the interest, but you're not actually repaying back the actual capital repayment to buy, let's say, that new iPhone. So, I would always encourage anybody to get a credit card, treat it as if it's their own cash. If you don't have the cash in your bank account, that means you can't afford it. So therefore, use a credit card more to your advantage. And what I mean by advantage, the main real purpose I use credit cards is mainly to build up my Avios points. So just last year, my wife and I, we were able to travel for free to Malta in business class.
Oh wow.
Return. And again, that was just funded by my Avios points. And also there was an offer on with American Express that if I was to spend a certain amount, I'll be able to get an upgrade for free and with a companion voucher as well. So we were able to travel to Malta for free, and I paid for all of that, for the difference just through my Avios points. I was gonna buy I was gonna buy, let's say, that takeaway, with my own cash, but if I put it on my credit card, I can build up my points. But each time I did that, I'm building up Avios points on the side anyway. But I'm very financially disciplined because I have a direct debit going out and I'm paying off the full statement balance every single month without fail.
Okay.
So that's how I use credit cards to my advantage. And the types of credit cards I've got at the moment in my possession is I have an American Express that's accepted in pretty much 70% of the main sort of high streets at the moment. Then we've got around 30% that only accept Visa and MasterCard. So I have a Barclays Avios credit card for that. For those other 30% of retail stores that doesn't cover American Express payments. And then the other credit card I've got is a Nationwide that doesn't charge me for overseas transactions and purchases that I make. So again, I'm not subject to those foreign transaction fees like I would with American Express. So as I say, I try to be very disciplined when using a credit card, and I think these specific credit cards, use them as a tool rather and make them work to your advantage rather than crippling yourself in debt by not making those full interest payments and statement balance payments every single month.
What bank do you think is the best bank to bank with?
At the moment, so for me, I use the HSBC Premier account, and that's for two main reasons, to be honest. So the great incentive that HSBC Premier have at the moment is that they provide worldwide travel insurance for you and your family, and also you get access to a digital GP, and so there is one more as well. You get access to a wealth manager and financial advisor.
Okay.
And I've actually used this service. So what that financial advisor actually does is he looks at your whole portfolio. He looks at your pensions, your salary, and is able to make slight tweaks or recommendations and advise on the performance of those. But he doesn't just look at that and that's it. He looks into other areas about insurance and protection. So for example, critical illness, income protection, life insurance. And it gives you a different perspective because it's all well and good being able to build wealth and build assets. But one thing we take for granted is insurance, right? And insurance is always there for a rainy day. And, we never know when we need to exercise that insurance plan. But again, it can protect both ourselves and our loved ones. So, he was telling me about an example where he had one client who worked in engineering, and, he advised them to take out critical illness. And after maybe around 6 to 9 months, the person became critically ill and wasn't able to work again. And his retirement was coming up after 4 years after him finding out he wasn't no longer able to work. So he was able to exercise that, and he was actually paid out for that up until retirement. And I think that is again a great thing that HSBC offer at the moment, and that is that service that not a lot of people know about. But I think people should be able to look into that type of account and be able to use some of its features that I think HSBC don't actually advertise as much as they should, I think.
Mm. Yeah, a lot of people nowadays they put themselves, and this is not even nowadays, it's been around for time, but people put themselves in financial traps all the time.
Yeah.
What is a silent trap that people don't hear coming?
I think people don't realize that they are going to put themselves into something called lifestyle creep, where every year they receive a pay rise and they receive a bonus. So what they decide to do is they think, I'm going to upgrade my lifestyle. So let me get a flashy car. So therefore I'm going to commit myself to a car finance for the next 36 to 48 months. And I'm also going to upgrade my house. And then all of a sudden they find themselves committed to all these high, lavish, expensive costs. And that's called lifestyle creep. So as they earn more, they are spending more and not investing any of that extra income. And so that's the silent trap, and that's the silent killer, because people don't realize that that's actually making them poorer purely because they are not investing in anything. They're using it on materialistic items. And again, it's to try and keep up with the Jones. And again, it's to keep up with, those lifestyle trends and that status.
So what would you say to someone who would say that credit cards are a financial trap?
I would completely agree with that. And I'd say credit cards are a financial trap, but they need to learn how credit cards can work to their advantage and also use it as a means to build up the rewards that come with a credit card, as opposed to using it, as cash flow and not being able to repay their credit card statement balancing for it every single month. Because if they don't and they can't keep up with payments, then unfortunately they will have to, go down the avenue of declaring themselves bankrupt. And I can see that it will be crippling for them and their families because they're bringing them into that insolvent position. But they have to be really, really disciplined when using a credit card. And again, they're only making, life essential purchases on them, not to start funding their Gucci bag or, their, I don't know, shop to, Bicester Village, for example, on all these materialistic items.
Mm. So when it comes to like people who are like giving advice on finance and let's say giving their perspective on it, what's the biggest myth you've seen online or heard online about finance?
That's a good question. I think the biggest myth I've heard is, saving is the most safest thing you can do. And to some degree, I agree with that. Saving is. However, you are not really gaining much by saving. You're only gaining the maximum interest, which is 4%. Whereas the investing side of things, it will give you more than that. Because remember, your money sat into a cash ISA is losing its value to inflation. Another myth that again I always hear is that paying off your mortgage is the best thing to do. The reason why I think that is just not the right way to look at things is because if you were to pay off your mortgage, the maximum return you can get on that, and let's say you're getting a mortgage rate of, let's say, 3.5%, 4% is 3.5%, 4%. But if I use that same money that I was going to make overpayments for or to pay off for that mortgage and I invested it in, let's say, 20, 30 years, I'm getting 8 to 10%. So I'm getting significantly greater returns on investing that in the stock market as opposed to paying off a mortgage. And alongside, that's one of the other reasons why I don't keep that much cash in a reserves, purely because our money's being lost to inflation. So I think that's definitely the two myths that I always hear and see that sometimes frustrates me, purely because people don't know how to leverage in the stock market their money.
Yeah. Is there anything that sounds smart but in practice it's not really?
From a financial perspective, something that sounds quite smart is perhaps paying off your student loan. I hear that all the time, purely because they think a student loan is a big amount of debt, and also they just want to pay off, probably similar to a mortgage as well. But it's not a smart way to look at it, purely because again, you look at the percentage interest rate
Yeah.
that people are paying on their student
Same
loans.
way as for mortgage.
Exactly.
Same thing. You could invest that money instead.
Absolutely, you can get a better return, right? And people think that if they're carrying this massive student loan debt, it's going to have an impact on how much they can borrow. But in fact, it's not. They don't look at student loans. They'll look at all the other things. For example, your car finances, your loans, and what's your credit card balance. But if you're paying off your credit card balance in full, then that's not considered. But they will take into account, this car finance loan and this any other loans that you may have and any other borrowings, and they'll take that into account and see how much can we then lend to this consumer and see whether or not they're able to keep up with servicing the payments on interest and being able to pay back that mortgage every month.
So if you was 18 today, what would your financial game plan be?
It'll be so much different, to be honest with you. I mean, look, when I was growing up, I was probably similar to you, looking to buy like fast, flashy cars. And I was just really looking to just kind of look at more materialistic items, purely because I want to keep up with the Jones, and again I want to keep up with the lifestyle trends. Little did I know, now that I'm a lot more older and wiser, that that doesn't hold its value. That's actually taking money out of my pocket. And if I was to perhaps invest that money and keep that money invested for a long period of time, that's what will actually make my money grow, rather than buying fast flashy cars. I had an M3 many years ago, for example, and trying to buy the best Air Jordans on the market at the time, right? So we're all victim to that. But I think it's also living life as well. And there's got to be a balanced approach. And I think what I did more spend than investing, because as I say, you know, again, it all stems back to your childhood. You know, talking about finance, investing was a bit of a taboo. People don't really talk about, you know, what they're investing, how much they're making. They're not really that transparent. However, social media brings that all to light because people are a lot more open, a lot more transparent, and you can start understanding, you know, how people can actually benefit from investing long term. But yeah, I think my 18-year-old self would approach things a lot more differently, and I have more of a balanced approach. Let's say I would probably invest, let's say 20% into the stock market, and the 80% I want to enjoy my life, and I would want to be able to do those things, you know, that I enjoy doing, and you know, going on holidays, making memories, and these sort of things on experiences, as opposed to just buying things that are materialistic and just depreciate over time.
Mm. Can investing alone make someone wealthy?
Absolutely. I think
Alone.
investing alone can. You look at Warren Buffett, for example, that's all he's done. That's at a young age. And he's invested, and you know, he's a billionaire just through investing. And if we don't invest, how are we going to build financial freedom? And when you look at when you're making payments into a pension, it's all invested. And that investment, if you, as long as you're staying consistent, it can give you that financial freedom. And people often see financial freedom as being in the millions. It's not. What people need to do is they need to look at their financial baselines. What is my cost of living for a particular month? And how much will I need for the next 20, 30 years that they want to spend in retirement, you know, and that will be able to stretch them out for that period of time, right? That's what people need to kind of look at and work out, rather than thinking, I need millions so that I can retire. So I think it's people's mindset and approach to how they're looking at investing and financing. But I think investing is certainly the way to go, because somebody that doesn't invest will start finding that they're not left with a lot when it comes to retirement, purely because they haven't invested into a pension, they haven't invested into any stocks and shares ISA, and again, they haven't invested in anything else besides just materialistic items. So therefore, they fall victim to relying on the state pension, which I don't know when it comes to mine or your retirement, whether there'll be anything in the pot for us to take out from. So I think altogether, you must set up, you know, investments, and whether that's through a self-invested personal pension if you're self-employed, or whether that's through a workplace pension, you know, where your company is going to make either matching contributions or a contribution up to a certain amount, you know, that's free cash sitting on the table. You should be taking it. There will be investing it. So I couldn't stress it more. Someone that is, again, 18 or younger, they must be making investments, no matter how small or large, as long as they invest in something. And again, they try and invest whatever they can. It's still better than investing nothing, because over time they'll see that that's going to build them wealth, but it'll build them wealth silently.
So for a young person, let's say with 100% of their energy, how much should be put out of the 100%? How much should be put in towards earning, saving, and investing?
Okay. So I think in terms of earning, so that's going more towards their skill set to be able to earn more. In terms of, if I was to apportion it, I would say they should spend around 40% on their earning potential. Yeah, because that's what will drive their income, right? And I would say, you know, the other, let's say, 60%, I'd probably say look at investing, right? Because I think what's going to help.
No saving.
Sorry, and you talk about saving, right?
Yeah.
I think sorry, in terms of, so let me look at the portion. I'd say 40% investing. I'd say 40% in growing their income, and 20% in saving. I'd say you must save at least around 20% for at least to cover those rainy days, and being able to dip into for those life emergencies. But I think investing in yourself is the best investment you can ever make, and as long as you can show that you're demonstrating as well to, you know, your employer that you're upskilling all the time in a new area, that's what's going to help you elevate your career and climb up that corporate ladder.
How much money do you think someone needs to start investing?
I don't think that you can actually put a number on it, because I think it's personal, because it's dependent on someone's personal income. But I think you can start off with as little as, you know, £5, £10, £30, whatever that person's comfortable with. But the way I look at it is that person who's investing, they should only invest what they're prepared to lose. So, and again, if they're looking just to make quick returns, then they should look at trading as opposed to investing, because that's what trading is going to give them. Investing should be, for the long term, because they don't need that cash. So somebody that's looking to buy a house, they may see a better opportunity saving that money, because again, they don't have to worry about all those turbulent times, because when they do want to put that money down for a deposit, their position in the stock market isn't sitting in red. It's tied up in, a cash reserve into a high yield saving account or a cash ISA that they can dip into. But it again goes back to that point. Your earning potential, there is no ceiling, right? So therefore, you want to invest a sizable amount into investing in yourself, on life skills, in courses, right? Because there's no ceiling, similar to investing. Whereas I know with a saving, right, you're capped at 4 or 5% in a savings account.
Yeah.
So you can see where I'm going with this, right? Where there's no ceiling, you invest, and you invest in yourself and you invest in the stock market. Where there is a ceiling, right, they're the things that again we should reduce our contributions to those pots.
What's your view on side hustles?
I think it's certainly something that I think most people should explore, purely because when you look at the cost of living, I mean, look, everything, everything's absolutely extortion at the moment. You look to fill your car up, before it used to cost you 50 quid, it probably cost you around 65, 70 quid now, right? For a full tank of petrol, for example, right? And you look at everything on, supermarket shelves, everything's gone up, right? So therefore, rather than working extra hours, right, we should try and explore side hustles. And we can explore side hustles in all different areas. We've touched on, bank switching. People can make an extra 200, 300, 400 pounds doing that. I know somebody that once made 600 pounds in one particular month by doing a few switches on their banks. They could explore freelancing. That could be freelancing in editing. It could be in tutoring. It could be, freelancing, or even, doing a little bit of child money, for example, right? So I think side hustles is definitely something that a lot of us are starting to explore a lot more, purely because the cost of living has made it really difficult to just rely on that one source of income, and you need multiple income streams to be able to get by these days, I think.
But now the government is cracking down on taxing these side hustles as well now.
Yeah.
So they're making it more difficult for people.
They are, but I still think, even though that the government are putting or imposing tax on your after your first £1,000 earned through selling either on Vinted or some of these side hustles, whether that's editing or online tutoring or wherever that might be, that shouldn't allow that person to not explore, putting in more hours, or being able to build up more and more stable side hustle income in this space. I think they should continue, and the tax man will always be there. No matter how much you earn,
standing by your
you've just got to pay it, right? We all become victim to paying tax, and we've got to do that because we live in England, right? But yeah, I think it shouldn't de-incentivize somebody just because of the tax system. We should just continue to find ways to build more and more income, because that again will have more money to either invest or allow us to have more income to be able to either go on holidays or on memories or whatever our aspirations are.
And what option do you think people are overlooking right now?
At the moment, I think people are overlooking using something called a lifetime ISA. And I don't know if you're familiar with what a lifetime ISA is.
I'll let you elaborate on it.
Yeah, so a lifetime ISA, so you can use it for either one of two things. So for example, if you're a first time buyer, you can actually put up to £4,000 into something called a lifetime ISA. And what the government will do, and as I say, you can only put a maximum of £4,000, they will top that up with 25% tax free. And you can use that, and you can build up that pot for the next 10 years, or however long you plan to continue to put into this part. And when you're planning to buy your next house, right up to the age of 39, you can carry on putting into this lifetime ISA, where the government will be putting into 25% contributions up to a maximum of £4,000 every year. And if you've already on the housing ladder and you're not actually, going to be using your funds towards a house, you can actually put money into this lifetime ISA, £4,000. I do it myself, and the government put in an extra 25%. So again, £5,000 every year. That's actually put into that pot every single year up to the age of 50, I think. You can put into that, and I can decide whether I want to keep it into a high yield savings account or I look to invest it. And you know what I'm doing, right? I'm actually investing it.
Yeah.
Purely because that's where I get the growth, right? So yeah.
You know what? Now, this has been an amazing talk, to be honest. And now I've come to the rapid questions, which is also the last bit.
Yeah.
So, best financial book.
I've got to say Rich Dad Poor Dad. For me, I've learned a lot. So, it's focused on the asset column. Your house isn't an asset, it's a liability because it's taking money out of your pocket. So yeah.
Biggest money mistake people make.
Biggest money mistake people make is using credit cards the wrong way, I'll say.
Most overrated financial advice.
Your house is an asset.
Most underrated financial advice.
Most underrated advice, I would say investing into ETFs, and it's not going to give you that growth.
Yeah. You know why I'm laughing is because this is the first time I'm actually doing rapid questions.
All right.
It's actually funny.
I'm enjoying it.
Yeah. One thing schools should teach immediately, obviously.
It's got to be financial intention and money management and financial discipline, right?
Yeah. What's one financial habit that changed your life?
I think it's altogether been investing regularly, because I think without them, I wouldn't see my portfolio at a particular value that I'm seeing today.
And what's the best return of investment you've ever had?
Again, I think it comes back to the ASOS stocks and shares that I bought around the pandemic, and I got incredible growth on that. But unfortunately, that was offset against, again, a poor investment. But I think I've learned a lot from that, and I've learned from those mistakes, and I'm not going to make those mistakes again.
Last one. If everyone could remember one thing from this conversation, what would it be?
I would say you are losing money to inflation if you're leaving it in the bank. And altogether, what we should do is have an appetite for risk. And we should only invest what we're prepared to lose. But investing in the stock market, when we look at the typical returns that the stock market has given, when you look at the S&P 500, for example, it's given them better growth. And, we should also explore other ways where we can make more income, just so that we have a better financial independence moving forward.
And was there any personal message you want to say, or?
I just want to say thank you for having me on your podcast today. I hope you've enjoyed it as well.
I enjoyed it, man.
Hopefully it wasn't just too much jargon thrown at you.
It was good, man. You done really well.
Thank you. Appreciate that, man. Appreciate that.